Principles of finance, a la shmup. Tax deduction math. All right, with this light introduction to taxes, let's work through a corporate leverage problem. Sounds fun, to the guys in thick glasses in the front row. And here's our Lemonade Stands Are Us company, a wildly successful decade later. All right, the company has, in our very theoretical example here, no cash and no debt. You, the wily CEO, wonder, gee whiz, what if we bought lemonade lovers for $15 billion? We'd be really big. We'd get cheaper prices for our cups and sugar and rent and be the brand in lemonade. Well, because you took this course on finance from your fine, loving people at Shmup here, you can easily do the math. Pro forma doesn't mean you get paid making a living as a forma. Pro forma means combined. So all this would be great if you could use a high multiple stock of your own to buy them. But your stock trades at only 10 times earnings, and to be bought, they want 20 times their earnings. You would suffer huge dilution if you used your own stock. If you pay cash, well, they'll take a lower multiple, 15-ish times earnings. Well, cash always has less risk, obviously, than stock. So you try to figure out how you can raise $15 billion of cash. We've been through the basics of investment banking 101, but here the focus is on free cash flow and debt repayment. So let's dream a little dream and say we borrow all $15 billion in cash. Well, some idiot or visionary is willing to loan us all that money for the leveraged buyout of lemonade lovers and charge us 5% interest on the loan. Yes, we are massively simplifying here. Thoreau has nothing on us. Quick math tells us that 5% interest on $15 billion is $750 million a year of interest. But that interest will shrink as we pay down our principal, right? And we know that if we can swing year one and start to really pay down that principal, well, this LBO, or leveraged buyout, should work great. So let's look at year one right here. Well, look how different things compare here with the first iteration with no debt. In the no debt scenario, we were paying $420 million in taxes. Now we're paying just $195 million because interest is deductible from taxes. The government essentially split our interest costs with us. Nice of them. And in doing so, it made the LBO work mathematically. You can assume that most of the net income of $455 million there is free cash, and our lemonade business has very little capital expenditures, which would cloud the net income versus free cash flow story. So in year one, we can take, say, $400 million of our free cash and pay down our debt principal to just $14.6 billion. Well, in year two, with less principal to pay down, our interest expenses go down, and by year 5, we're sitting pretty fat and happy, even assuming no growth or additional synergies from the merger that we just did here, or really it's an acquisition. And note that we only included a relatively small expense savings of $200 million by way of being able to buy our supplies a bit cheaper with huge Walmart-like scale in the lemonade biz. It's likely that there are more savings we'll be able to find and more revenue growth opportunities to be had as well.